You'll find the link to AI powered crypto starter vault in the description and pinned in comments below. You could lose more than your gains in crypto because of a tiny tax mistake. The IRS is watching more now than ever. One small error on a tax return can cost you thousands. In the next few minutes, you will learn how the IRS treats crypto. You will learn which transactions create taxable events. You will learn three audit magnets beginners often miss. You will get a step by step playbook to fix past mistakes. You will learn one lesser known tactic that can reduce your tax bill if you apply it before filing. If you want more no fluff crypto breakdowns that actually help beginners keep more of their gains, subscribe now. We release practical deep dives every week. They do not track price charts, they track records. Here is how the IRS sees every move you make with crypto. Crypto is classified as property for tax purposes. That classification changes everything. Selling crypto for fiat is a taxable event. Trading one crypto for another is a taxable event. Spending crypto at a merchant is a taxable event. Receiving crypto as income from airdrops, staking, or mining is taxable as ordinary income. Think of crypto like collectible cards where each trade or sale can realize a gain or loss. Picture a 10 times trade erased by a tiny reporting error. That is not drama, it happens to real people. But one common event nearly everyone forgets is coming up next. Most beginners think only cashing out to US dollars matters for taxes. That assumption is wrong and costly. When you trade BTC for ETH, you realize disposition of the BTC at its USD value. When you spend crypto to buy coffee, you disposed of the crypto and may have a gain or loss. Airdrops and staking rewards are often taxable when received as ordinary income. Interest or yield from decentralized finance can be taxed as income and create further complexity later. Short term gains are taxed at ordinary income rates. Long term gains qualify for lower capital gains rates if you held the asset over the threshold. Here is a simple visual: buy price plus hold time plus sell price equals short term or long term gain. Exporting your transaction history is the step that saves you hours and cents. The cost basis method you choose can change your tax bill dramatically. Common methods include FIFO and specific identification. Specific identification allowed by the IRS if you can prove it with records. If you can point to exact lots and timestamps, you can reduce taxes in some cases. Messy records make you overpay, clean records can save thousands. You should document timestamps, amounts, and US dollar value at each transaction. Export exchange CSVs and wallet histories monthly to keep things manageable. There is one field accountants obsess over in those CSVs: the timestamp and cost basis. Download everything before your accountant asks. One checkbox in Form 1040 can trigger a deeper review. The 1040 asks if you had any virtual currency transactions during the year. Answering that question incorrectly can lead to penalties or audits. Form 8949 lists each sale and disposition of property, including crypto. Schedule D summarizes capital gains and losses from Form 8949. Some taxpayers receive 1099s for crypto related income from exchanges or services. If your employer paid you in crypto, you might get a W-2 reflecting wages or reportable income. Penalties exist for failure to report, but honest mistakes are often correctable. Do not assume small amounts or dust are harmless. Small repeated unreported trades create mismatches between reports and your tax return. Those mismatches are low. Many notices begin. That low those mismatches are how many notices begin. Here is where most creators skip the hard part: forks and airdrops. Hard forks can create new tokens that you receive without giving anything in exchange. Airdrops distribute tokens, often without payment. The IRS has signaled that some airdrops and forks can be taxable when you have dominion and control over the new tokens. Many people treat free tokens like play money until a tax bill arrives. Document receipt dates and the fair market value in US dollars at the time you receive the token. If you sold the token later, you may also have a capital gain or loss on disposal. This ambiguity is why good records matter. Now I'll walk you through a practical record keeping system that works. You do not need perfect memory, you need repeatable evidence. Step 1: export monthly comma separated values from every exchange you used. Step 2: export transaction histories from every wallet you control. Step 3: save each comma separated value in a folder labeled by year and exchange or wallet. Step 4: create a master spreadsheet with columns for date, asset, amount, US dollars, value at the time, transaction type, and notes. Step 5: label every transaction with a type: buy, sell, trade, spend, airdrop, staking income, yield, or other. Step 6: keep merchant receipts when you spend crypto to prove the purpose of the transaction. Step 7: back up your records both in the cloud and on local secure storage. If you have more than a handful of trades, consider using tax software designed for crypto. Tax software can match exchange reports and produce Form 8949 entries for you. If you have hundreds or thousands of trades, software becomes essential. If you receive a notice from the IRS, respond quickly and do not panic. Gather your records, identify the mismatches, and if needed, consult a qualified crypto aware chartered professional accountant. Amending past returns proactively often reduces penalties compared to waiting for an audit. You can file a Form 1040X to correct material mistakes or missed income. Voluntary disclosure is more likely to lead to resolution than silent avoidance. If the IRS sends a notice, it will include a deadline and instructions. Follow them. Here is the hidden mistake that catches many people ignoring tokenomics events like splits, forks, and airdrops. People see free tokens and think they are worthless for tax purposes. The IRS treats economic benefit as potentially taxable. That means you might owe ordinary income tax at receipt and then capital tax later when you sell. A real case, someone received an airdrop, sold the tokens later, and owed both ordinary income and capital gains on the same asset. That surprise can be avoided with timely documentation and reporting. Now, the single most practical playbook to protect yourself. First, export every exchange, comma separated value and wallet history for the rest for the relevant tax year. Second, choose and document your cost basis method and stick to it. Third, classify every transaction by type to clarify income versus capital events. Fourth, prepare Form 8949 entries for each disposition and summarize on Schedule D. Fifth, use crypto tax software for large portfolios and generate an account accountant friendly report. Sixth, if you missed significant income in prior years, consider filing an amended return. Seventh, respond promptly to any IRS notice and keep copies of all correspondence. Eighth, consult a chartered professional accountant experienced in crypto tax issues if your situation involves decentralized finance, staking, or foreign exchanges. Good records turn panic into proof. If you can pull a clean year of exports and a documented method quickly, you reduce the chance of penalties. This plays out not just in audit avoidance but in keeping more of your gains. Before we finish, there is one last tip most beginners miss that can lower next year's tax. Harvest losses strategically where appropriate to offset gains. If you have losing positions, you can sell to realize losses and offset gains, subject to rules and timing. Be careful about wash sale rules in your jurisdiction and how they may apply or not apply to crypto. Document loss harvesting in the same organized system you use for gains. Now, a short list of forms and what to expect when preparing them. Form 1040 includes the cryptocurrency question right near the top. Form 8949 is the line by line schedule for each sale or disposition. Schedule D aggregates your capital gains and losses for the tax year. W2 and 1099 forms may reflect crypto income in some situations. Keep copies of any 1099s you receive from exchanges or services. Your tax return should reconcile to exchange records to avoid mismatches. If you have complex decentralized finance interactions, consider a specialist because automated reporting can misclassify events. If you receive a notice, stay calm, collect documentation, and consider professional help. Here is how to fix past mistakes without making them worse. First, confirm the magnitude of the missed income or misstatement. Second, prepare an amended return with supporting documentation and a clear explanation. Third, if penalties are assessed, consider reasonable cause explanations or payment arrangements. Fourth, keep records of your proactive steps and correspondence. Proactivity reduces both penalties and stress. Now, a practical checklist you can follow right after this video. Export every exchange, comma separated value and wallet history for the tax year. Document your cost basis method and save proof if using specific identification. Classify each transaction by type and record US dollar value at transaction time. Use crypto tax software for high volume trading to create Form 8949 entry. File amended returns for any significant missed income and keep copies. Backup all records in at least two secure locations. Consult a crypto savvy chartered professional accountant when in doubt or when you receive a notice. If this helps you take control of crypto taxes, subscribe for more practical breakdowns. Join the community so you can learn from mistakes others made before you. Records and method beat luck. If you control your records, you control your tax outcome. Before you file, remember this: export now and document everything. This one habit prevents the majority of audit triggers. If you want the next step, watch our video on resistance, support, and market psychology. That video will help you protect gains and avoid panic selling when taxes loom. Click the link on the screen now to continue learning.